The market has been nothing short of crazy recently, and although it feels like everything is reaching all-time highs, there are still some stocks that are relatively cheap and present big future potential. So let's talk about those opportunities in today's video. As always, nothing in this video is financial advice, and you must do your own thorough research before deciding to add any stock to your investment portfolio. But if you don't know where to begin when it comes to picking stocks and researching stocks, don't worry, I have a whole workshop that is literally a blueprint for that will help you out. I'll leave that in the description below. And for full transparency, I have one of these 5 stocks that we're going to cover today in my own portfolio, and I'll make that clear as we move through the video. So first up, we have a stock that I've never spoken about before on this channel, and actually I don't really see many people ever mention this one. It is one of those stocks that is pretty overlooked when it comes to the tech sector. I never really hear anyone mention it, yet I bet the majority of people, maybe 80% plus, have heard of this company or even used this company's services. And this is an e-signature company called DocuSign. At time of recording this video, DocuSign stock is about 81% down from its all-time highs reached in September 2021. So in a relatively short time period, this stock has reached all-time highs and then fallen significantly. So why is DocuSign a relatively cheap stock right now, and why might this present a buy-in opportunity? Well, firstly, they are market leaders and they have the majority of the market share. Personally, I've been using e-signatures for many years, and with the way that the world's moving, I really don't see these getting unpopular. I only see them increasing in demand, and at the moment, DocuSign services are absolutely in demand. Most people nowadays are working remotely and they are having to sign things not in person, and actually signing things in person is quite a big waste of time and effort in my opinion. And obviously when it comes to signatures, e-signatures, these things are not limited by a particular sector, by a particular industry. And you can see here, this is a slide taken from their most recent earnings presentation, that they are the world's #1 e-signature solution. And there is a big, large market opportunity of about 50 billion in the total addressable market. And not to mention their customer base is huge, 1.51 million, and they specify here this is across all industries, all segments, and all geographies. And you've only got to look at this picture here to see some of the most trusted leading brands, biggest companies in the world are customers of DocuSign, and they trust DocuSign, ranging from Santander to Stripe to Microsoft to Unilever, big companies. So talking about their Q4 earnings, they were really strong. And actually one really interesting thing that was highlighted is their international revenue is really increasing. And it's actually now at the stage where it's outpacing the growth of the overall revenue in Q4. The international segment took up 27% of the entire revenue, which is quite significant for any company actually. And then just in general, we can see the total revenue growth continuing to rise over time. And we can see that we saw an 8% increase in Q4. Yeah, this isn't significant. This isn't as significant, as we saw maybe in Q1, but it is still growing. And that's the most important thing here. You can see that every single quarter there has been a revenue growth. Outside of revenue, they have also shown their cash flow increasing, which is obviously something that you want to see for many businesses. And then when we think about customer diversification, you saw it when I just showed you on the screen there, but many different sectors. They are not limited by one sector, which makes their total addressable market, like I said, estimated 50 billion, really big. And there's a lot of untapped market there as well. And when you're not reliant on just one particular sector or even one company, a few companies, you're not as restricted in terms of where you get your revenue from, which then reduces your risk. Because if one of those companies no longer needs to work with you, I mean, yes, if it was Microsoft or something like that, it would be impactful. However, you've got many other customers, many other industries across the world that need your services. So we are saying there is customer diversification. There is an estimated 50 billion total addressable market, and a lot of that is untapped. We're saying that this company has high margins, massive client base. They are the market leaders with the market share. They have a healthy balance sheet. So that all looks good. But of course, with any investment, there are some risks. For DocuSign, there has been a number of rumors about an acquisition that may happen for this company, so do keep your eye on that. But also there is the question of whether or not they are utilizing their cash to its fullest potential. And obviously as shareholders, we do want to see that they're actually putting that cash, shareholder money as well, to good use to grow the company over time. Next up, we have a stock that has done just over 487% in 1 year. And this company you might not have heard about before is Giga Cloud Technology. And you can see that it has been way outpacing the S&P 500 as of lately, but it has also been pretty volatile. They are a leading B2B, meaning business to business marketplace provider. And they operate Giga Cloud B2B Marketplace, which is basically their platform that integrates product discovery, payments, logistics, all of that stuff into one user-friendly platform, making it super easy for customers of theirs to use it. What do they actually do with this platform that they have? Well, they facilitate transactions between different manufacturers in Asia and resellers across the globe, and they focus on large parcels. So, those big and bulky items. And they make money through various services. So, for example, when a transaction is placed on their platform, they earn a percentage. And that is obviously based on the transaction value. They also charge fees for warehousing. So this just means storing the products. They charge for delivery, delivering the product to the final destination that it's trying to get to, and ocean transportation as well, which obviously just means shipping products across the ocean. And talking about their most recent earnings, well, they were good too. They reported a revenue growth of 95% year over year. They reported that their gross margins had increased to 28.5%, and their net income increasing by 185% year over year. So basically really remarkable results. We should also mention that they have actually done 2 big acquisitions recently, one acquisition of Noble House and another of Wondersign. Both of these were done using cash on hand, which is a real positive to see. And this just shows us that they are constantly trying to reinvest money to expand and grow their market share and cement their competitive advantage over time. So we've just looked at a stock that has been performing very well recently, but now let's take a look at one that is actually 73% down from all-time highs. This is one that I have mentioned on my channel before, but it is positioned in an incredibly competitive industry. However, it is an industry that is one with lots of predicted future growth. The company is Block. You might also know this one as Square. This is a founder-led company, so a guy called Jack Dorsey, who actually founded Twitter too, founded Block. And I don't know if that really bothers you, but that is always a good sign for me. I quite like companies that are founder-led, just because it shows that, the person that knows the most about this business and about the industry that it is in is still leading the company. It is the person that is naturally going to care the most about what happens. There are many good reasons as to why founder-led companies do particularly well, and some of the best companies in the world are founder-led. So the total addressable market, the TAM, for a company like Block is hundreds of billions of dollars. And according to management commentary, the Block business opportunity could be as large as $205 million of annual gross profit. And they actually see that this opportunity is split into 130 billion for Square and 75 billion for their Cash App. There has been strong year-over-year gross profit growth, and there has been growth in all 3 business areas. So corporate, the Cash App, and Square. Another thing that I think gives Square quite a competitive edge and does position them well in this day and age is their commitment to blockchain technology. So they quite literally changed their name from Square to Block to reflect their focus on blockchain technologies like Bitcoin. So businesses can use their Square payment system to accept payments in crypto, and then outside of businesses, non-business individuals can actually buy and send each other crypto using their Cash App. And Block, they do care about this stuff, and they should, in theory, benefit from the increase that we're seeing in crypto, especially as we move towards and past the halving event. So far, we have spoken about stocks from the tech sector and the fintech sector. So now let's move on from that and actually speak about a REIT, a real estate investment trust. This one is one of the most popular REITs out there, and it's one of the most popular dividend stocks, actually, dividend REITs, I should say. And that is because it pays monthly. It is a dividend paying stock. If you haven't guessed it already, that is realty income. So you can see here that it's not been a great year by any means for this company, and that is just because Put simply, it has been a pretty tough macroeconomic environment. Interest rates affect REITs in actually many different ways, but just for one example, REITs often rely on borrowing to actually finance the purchasing and development of their properties. Higher interest rates, of course, push up the cost of borrowing, which then reduces their margins, which has a knock-on effect to their earnings and to their business as a whole. But with interest rates potentially coming down and the macro environment improving, things could really get better for Realty Income. You've only got to look at their stock chart to see that a company like this, a REIT like this, can be quite volatile and it can be quite cyclical as well. And that just means that, if you're smart about this, potential money could be made. So when we take a look at Realty Income's portfolio, it is quite strong. You'll be able to see here, they have over 15,000 commercial properties under long-term net lease agreements, and they have an occupancy rate of 98.6%. And their occupancy rate has actually never fallen below I think it's 96%. It's very, very high. They really do exceed in that area. They have over 1,300 different clients in 86 separate industries. They have got a very, very strong diversified portfolio. And that doesn't just stop there, because you can see here, they're actually diversified across many countries all around the world. The majority obviously come in from the United States, but it doesn't stop there either. You can see here, we've only got to expand out into Europe, many in the UK, and that is obviously a very good thing to see. Diversification is always good for a business. Some really featured, well-known clients that they have, you can see here, mention Sainsbury's, which is very popular here in the UK. And yeah, very, very, very good portfolio. There are other good REITs as well, but I do think Realty Income is definitely one that's worth looking into if you want that sort of thing in your portfolio and you care about the dividends as well. The last one is one that I have in my own portfolio, and I think it is a stock that is currently being undervalued by the whole market. It's a very polarizing company. Some people love it, some people hate it. Some people have this stock as their only position in their portfolio. Other people really don't see the potential. If you haven't guessed it already, it is of course Tesla. So Tesla is one of those stocks that has managed to help many, many people retire early. It's made people so wealthy, but there is no denying that recently it has not been having that good of a time. You can see here year to date down by 33.62%, and over the last 1 year as well, a similar picture, not really moved as much, not really returned investors very much, down by 11%. However, if you start zooming out, you can see how well this stock has done in the past. So why do I think this stock is currently very cheap? I think Tesla is one of those companies that is always going to be spoken about in the mass media. And quite a lot of the time, the mass media don't always show you the truth about what is happening. And I think that has really been seen when it comes to Tesla. Many, many times we've seen headlines that are honestly just not the truth. They're not the truth. They have no hard evidence, and it does cause a lot of people to trade the stock. It causes a lot of people to sell out of their position if they haven't done their own thorough research and they're not as convicted. They can't ignore what they're reading, and it's a real shame because for a long time Tesla has been valued, has been thought about as a car company. However, we are now on the verge of some massive catalysts. Elon himself has said that they are going to be licensing FSD to other car companies, other automotive companies that want it. They are, of course, going to have the next gen vehicle, which is going to increase market share. However, there has been this whole thing on X recently, literally yesterday, that it's going to look a little bit different. There was an article that came out that's basically said they are cancelling their next gen vehicle. Not true. Yet another lie. Elon Musk has confirmed this himself. But maybe they are prioritizing the robo-taxi fleet, which is of course going to be the same platform as the next gen vehicle, just perhaps without the steering wheel. Very, very exciting. They are seeing that they are progressing FSD at such a speed now, and it's getting so close to being as good as they need it to be, that they can prioritize the robo-taxi fleet. And actually, Elon put a little spoiler out on X saying that the robo-taxi is going to be unveiled on the 8th of the 8th. Didn't give a year. Could be this year, could be in 10 years' time. Who knows? However, I think there was the estimation that it would be that the production would start in 2025. So if that is the case, unveiling it on the 8th of the 8th this year does make sense. Tesla also put out this post as well yesterday, which shows that they have now hit over 1 billion miles driven on FSD. And you can actually see that there has been a recent inflection point, and that could be due to the 3-month FSD trials that have been going out, but it is increasing exponentially. And there is no denying, that Tesla have the data advantage. That is something that they've always positioned themselves to have, and it's absolutely paying off now. Of course, we've seen FSD updated versions rolling out. They seem to be getting better and better. People seem to be very, very impressed. And people that have no interest in Tesla stock, that don't really have an interest in Tesla as a company, but they happen to have a Tesla vehicle, are also now trying FSD, and they are reporting very, very positive things on it. And I'm sure it's not going to be long until we hear that Tesla bots are actually working in factories, Tesla factories, doing very, very useful work, which of course will then save Tesla money. It will increase efficiencies, and it will bring margins up even more. This is all very beneficial. There are many, many things that I could say here, but I also want to just quickly mention that we did recently have Tesla's delivery numbers come out, and they weren't really what people were estimating. They fell a lot lower than most of the Wall Street estimates. And, that did cause a bit of a stock market sell-off. However, these things don't matter too much in the grand scheme of the bigger picture. How many cars they delivered in Q1 2024 will seem very, very insignificant when we're 5 years in the future and we're looking at the progress that we've had with FSD and everything else. We also must remember that this wasn't just specific to Tesla. The rest of the industry was also struggling as well. You look at Rivian, you look at BYD, you can see a similar sort of thing. With all that said, let me know if you have any of these stocks in your own portfolio, or what stocks you are seeing right now that you think are very, very cheap. Until next time, keep investing, keep analyzing, and don't forget to hit that subscribe button.